Welcome back to our channel where we discuss all things crypto. In this video, we will be talking about the role of market psychology in crypto trading. Market psychology refers to the emotions and behaviors of market participants that influence market prices. Crypto trading can be volatile and unpredictable. Market psychology plays a crucial role in determining market trends and the price of cryptocurrencies. When a cryptocurrency's price is rising, it can create a feeling of FOMO or fear of missing out among investors. This can lead to a rush to buy, which further drives up the price. On the other hand, when the price of a cryptocurrency is falling, it can create panic among investors, leading to a sell-off and further price drops. It is important to remember that market psychology is influenced by a range of factors, including economic news, social media, and even rumors. As a crypto trader, it is crucial to have a good understanding of market psychology and how it can affect your trades. You need to be able to manage your emotions and not let them cloud your judgment. One way to manage your emotions is to have a clear trading plan and stick to it. This can help you avoid making impulsive decisions based on fear or greed. Another important factor to consider is the role of institutional investors. As institutional investors, such as hedge funds and investment banks, begin to invest in cryptocurrencies, they can influence market psychology and prices. In conclusion, market psychology plays a significant role in crypto trading. As a crypto trader, it is essential to understand how emotions and behaviors can impact the market and your trades. By managing your emotions and having a clear trading plan, you can make informed decisions and avoid making costly mistakes. Thanks for watching. Please like and subscribe to our channel for more crypto content.